Kunal, you mentioned you're into private equity, right? If you can break down what exactly is private equity?
So private equity essentially is investing in unlisted companies. Before a company has to go public, or before a company has to take that leap to enter public markets, a company still needs capital, right? Whether that is for any capex, whether that is for working capital, all sorts of business needs that are there, acquisitions. So any of these needs that are there, they require capital financing. So that's where private equity comes in, and essentially that's about. And then how an exit works within private equity is also very important, because large private equity firms in the world, when they invest in a particular company, they have a roadmap up to the exit. Now the exit is usually, in more cases than not, is an IPO, which is to take the company public. But the reason why companies require private equity financing is because not every company already has the tools to go public. So there is that certain period that you require before a company can really go public, and that's why private equity investing plays a huge role in helping companies grow.
Got it.
This trend has become more popular in the recent times. Till 5, 6, 7 years ago, smaller companies had forget about access to private capital. They didn't even have access to public capital. But the way things are growing today, more and more investors, large investors, are willing to take a bet on the company even before it goes public, right? So they would have comfort and faith on their business model, and of course the assurance that the company will go public soon. And hence there's a very large amount of capital willing to be deployed in companies which are about to go IPO. So that's another area which is growing very fast.
Is it because the whole India story is blossoming so beautifully, and the investors are more and more bullish on not just the established institutions but also the smaller players who are coming across in, say, tier 2, tier 3 areas of the country? Is that the main driving force behind this?
Of course. So one is the country's growth. Second is capital markets, which are so linked to the country's growth. They are all doing well. And now what's happening is that the larger investors, we are talking about the HNIs and the family offices, have become more patient in their approach, right? So they are willing to take a 2, 3, 4 year bet on a company. They are willing to invest today, see the company go public in a year's time. Again, anyways, in SME they have a 1 year lock-in, in main board they have 6 months lock-in. But forget about the lock-in. Despite listing, they are willing to wait for another 2, 3 years, see how the promoters are able to grow the business post capital raise, post equity raise. How they are able to deploy that amount profitably in a better way, and sustain their already efficient businesses which were there when they took them public. So the point today is that there is a very good amount of capital which is willing to bet on these companies even before the IPO, which is a trend which was seen only in larger companies. The proper private equity firms which used to cut few $100 million checks earlier. So this segment was a very, very limited segment earlier. Now what's happening is that you can raise even $2-3 million in a company before the IPO, which was not the trend. Till 5-6 years ago, you would hardly see any such instance. But now you see so many companies which are going IPO, whether SME or main board. You would see so many of them as you read their DRHPs. You would see so many of them which have raised capital 6 months before, 9 months before, 12 months before their IPOs, right? That's a very powerful trend, because it gives so much comfort to the owners of the company. End of the day, it's a growth capital. If a management, if the owners of the company have plans, vision to raise capital and quickly fast track that growth, there is capital willing today to back them, which was not the case earlier.
And an important point here also is that for an outsider listening to this, maybe it would look like private equity investing looks all great and rosy, but it comes with its own risks, because when you invest in a company which is private, there could be n number of things that could also go wrong tomorrow if the company doesn't list. If it has any kind of, there's no way to really sell your shares. When you're investing in a public stock, it's a liquid market.
At least profit loss you can sell.
So there are sellers and buyers in the market. It's a marketplace. For a private company, there's a reason why private equity firms also manage to buy these stakes at cheaper valuations or sort of reasonable valuations. is because they take that first leap of faith in the company. That investor has to be rewarded well when it comes to IPO, because they are showing that faith when nobody is willing to show that faith in the company. So that risk that is there from investing in the company when it is private and until you take it public is pretty high. There's no fallback option for the money that you are investing, other than, you know, figure if the company gets acquired, well and good, sure. But if it has to go to IPO, there's a lot of hurdles you have to cross to get to that IPO stage, whether it is SME or main board. So private equity investing does come with its own risks. It's not as straightforward as it might seem.
So this is not private equity in the traditional sense.
Yes.
You know, private equity means a certain set of private equity firms which are taking a board seat or putting larger, you know, amount, you know, cutting bigger checks. It's not that. It's like you can call it pre-IPO investing or an unlisted investing, where a group of HNIs sometimes, or sometimes one or two large anchors come and, you know, put in the checks. The fundraise can be $2 million, $3 million, $4 million. It's a very small amount. That too, a group of HNIs come and invest, right? So each individual may cut a check as small as $100,000 or sometimes even lower, right? But collectively they put $2, $3, $4, $5 million in a company before the IPO. What the good part of this approach is that it gives so much confidence to the owners and the management, right? That there are people willing to back us even before we are going public, right? And then it becomes in everybody's interest, right, to take the company public sooner.
Yeah.
And another thing to add here is also that, you know, a very important part of this private equity investing is that if your intent is to take a company to IPO, as an investor who invests in an unlisted company first and then takes that to listing, you're locked in for a certain period of time. So like sir said, you know, it gives a lot of confidence to the company, to the promoters, that there are investors who are willing to back us, and not just back us in the short term. These are investors who are very well informed that their investments will only be realized after a certain number of years, which is 2 years, 3 years.
Yeah, bare minimum is 2 years, right? I mean, certain time to take it public and then certain lock-in period. So practically they can't exit before 2 years. So they are anyways taking a long-term
bet. Yes. So I think that's a very important point to know as well.